Okay, let's get started. Good morning and welcome to today's Tuesday Markets Outlook session. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I am going to be sharing my thoughts and analysis on the current markets. So before we get started, just the usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only. And should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, as usual, kicking off with the major indices, highlighting those key levels. From there, we'll be moving on to fixed income commodities and take a quick look at Bitcoin as well. We'll highlight the sector rotational model, look at which sectors are outperforming and underperforming the overall markets. We'll take a look at some subsectors of interest that I have for you today, and we'll end today's session with some bullish and bearish market observations. So starting off with the Fed rate hike probabilities before we move on to the major indices, and I'm really focusing on the 22nd of March. That is the following meeting after next week's meeting on Feb 1st. Reason I'm focusing on the following meeting is because there's a 99% probability based on Fed futures that we will get a 25-point hike come next week. So I don't think there's much point in analyzing those numbers. Right now, we should be setting our sights onto the following meeting. And there is still a lot of time between that meeting, around 7 weeks or so. So there's a lot of economic data that could come out during that time that can definitely shift these numbers. But right now, what we're looking at is the high 85% chance of another 25-point hike, because right now, the current target rate is 425 to 450. We will get a 25-point hike, which will take it to 450 to 475 next week, and another 25-point hike on the next meeting in March will take the rate to 475 to 500. Now, we did know that the Fed was definitely going to be, or most likely going to be doing a more modest hike compared to the 75-point hikes that they were doing last year. So this doesn't come of much news, but that being said, if we do see inflation start to tick up, or any let's say negatively perceived economic data with regards to inflation, we could see this number shift quite considerably. The other thing to point out is that even though we are expecting a 25-point hike next week, and that has been priced in, it's been priced in for quite a while, what I would be focusing on is the forward guidance from the Fed, with respect to, more specifically with respect to how long they expect to keep rates elevated, because that's what the markets are focusing on right now. And that is what is also dictating, other than earnings, that is what is also dictating price action in equities. So that will be the key focus for next week, is how long the Fed intends to keep interest rates elevated. Okay, taking a look at the S&P 500, looking at the SPY ETF, and we are seeing some bullish price action. On the weekly time frame starting off, we definitely see a bit of a bottoming formation, the bottom being the 50% fib level from COVID lows all the way to all-time highs at 350. Price did manage to find this level and immediately bounce higher. And we are seeing a higher low, somewhat of an inverted head and shoulders. I wouldn't necessarily say it's the perfect inverted head and shoulders, but price did manage to find support at the 38.2 fib level, which is a 380 area on the weekly time frame. Also, we still have this descending trend line that looks like it is about to be broken. Depends on how you draw it, but the fact that there's momentum heading into this trend line, and we are seeing bullish price action, especially yesterday, a very big bullish day, that does indicate that this trend line does look like it will be broken to the upside, and that would open the door for a revisit back to 410 in the near future. So I do have a short-term bullish view here on equities, despite the fact that futures are a little bit down this morning, and despite the fact that we're still early into earnings season. So there is a lot of ambiguity as to what could happen, but my thesis would lean more to the slightly bullish side. Reason being is that this earnings season is based on numbers from the end of last year, and the end of last year did show some very good consumer spending, very high level of consumer spending. And I do expect that there should be some upside surprises for this season of earnings announcements. However, we are seeing company layoffs, on a pretty big scale. A lot of forward guidance from these companies is negative, and there's a lot of pessimistic thoughts here about the markets moving forward over the next few months. So even if we do get a very positive earnings season, it's been mixed so far, but mixed to positive, I would say. If you do get a more positive earnings season, I don't believe that'll be a long-term driver here for equities to continue higher. I think it'll be more of a short-term boost, but markets are going to be looking at the forward guidance, and they are forward-facing, these markets. So that is what you want to be focusing on when it comes to these upcoming earnings announcements. So we have resistance at 410. Should that level break, I'd be looking for a revisit back to 428 or even 420, which is actually the 23.6 fib level. Slightly different levels in the weekly and the daily, but either way, you're looking at a potential breakout opportunity, and a revisit back to that 420, 430 area here for the S&P. I definitely do think we've reached our bottom at 350. And yes, there's some recessionary fears. I don't expect that to really drive markets that much lower. A lot of that has already been priced in. Taking a look at the NASDAQ 100, huge day for the NASDAQ 100 yesterday. Focus on the weekly time frame first. We have supported the 270 to 260 level. Price has found support there and does look like to be rebounding from that. Overall structure does remain quite bearish, pretty steep bearish trend line. And obviously that has to do with the fact that the NASDAQ 100 is more exposed to technology names, more exposed to high growth stocks. And these are stocks that perform quite poorly in a rising interest rate environment. However, sentiment is shifting. We are seeing signs of more dovish Fed. Well, the Fed has definitely been a bit more dovish than a few months ago. But again, it depends on how long interest rates are going to remain elevated. That'll be a huge driver as to where price action would go for the NASDAQ 100. Recently, price did break above its 21 and 55-day exponential moving average. Small pullback, and again, a large move higher. It does look like a move to 300 is on the cards here for the NASDAQ. And that is a key resistance area as well, key psychological level. So that'll be the area of focus for the Qs. Right, taking a look at IWM, which is the Russell 2000 ETF. So looking at small caps, and it's a pretty good performance from small caps in the last few weeks relative to large caps. We are seeing price at that key resistance area now at 188. I actually cropped this picture by mistake slightly, but that is the 38.2 fib level. So major area of resistance, but also provided support in the past. And let's see how price actually behaves in this area. I do think there's a potential for a breakout opportunity for small caps, especially with equity optimism returning, momentum turning positive on the daily, and improving momentum on the weekly time frame. So this is quite indicative of a breakout. Again, earnings could be the catalyst for that. But should we see a breakout, I'll be looking for a revisit back to not only 200, but even 210 or in the months ahead, potentially, as that is a 23.6 fib level. Again, another major area of support and another major area of resistance. So when it comes to small caps, definitely looking a whole lot more optimistic than a few months or even last year. Okay, moving on to TLT, which is the bond ETF. And this is pretty much what I've been saying for a few weeks now, as my sentiment remains neutral, maybe slightly bearish here and there. And this is actually a good bearish entry point, if anything. So we have overall structure remaining bearish on the weekly time frame, lower lows, and I would maybe consider that a higher low, but again, not really that much indicative of a overall change in trend from bearish to bullish. If anything, for now, it looks like it's changing from bearish to neutral. We did see price rebound from 92, and it rallied all the way to the previous swing low at around 106, 107. ran into some resistance, moved a little bit lower, again retested that level last week and failed. So we are seeing multiple rejections at around that 106 level. And that just speaks to the fact that I do see TLT in a more neutral light. I do see bonds in a more neutral light. Big reason is that we know where interest rates are heading. Only question is, how long they'd be there. But, it's only when we don't know, we may know the direction of where interest rates are heading, but we don't know the destination. That's where we see a lot of volatility with this ETF in particular, because like we saw, in the previous months with this steep decline. Whereas now that we know interest rates are going to be at around that 5 or just over 5% level, TLT has priced that in and is now more neutral. I still think you can play with this using that 106, 108 area as resistance. We are seeing price fail at that level, and that provides a good risk to reward bearish entry point, more ideal for a credit spread as opposed to a debit spread, as I think declines are somewhat limited here for TLT. That being said, if we do see a breakout from 108, I'll be looking all the way to 120. That's the next key area of resistance to be looking at. Okay, moving on to the US dollar index, DXY. And sentiment remains bearish. I had a slightly more bullish sentiment for the dollar heading into this year, especially with recessionary fears, especially with the fact that interest rates are still moving a little bit higher. But you have to look at the other currencies. ECB, European Central Bank, is now looking at a 50-point hike for the euro, which is a more bullish case for the euro, and therefore the spread differential with regards to interest rates between the dollar and the euro is going to be tightening. So for that reason, markets are pricing it in, and we are seeing a move lower here for the dollar. Not an absolute collapse just yet. We did see a sharp move lower, followed by some consolidation, some choppy price action, and that's been pretty much the tone for quite some time. Sharp move lower, followed by consolidation. It does look like even the price is finding some support at 102. This area between 100 and 102 would be the key area of support here for the US dollar. So not a lot of upward momentum. Sentiment remains bearish. Question is how much lower could it really go? I'd be surprised to see price break below 100 in the next few weeks. I think there should be a solid area of support. And even if it does move a little bit lower, the price would reach an oversold condition. So dollar remains bearish, but choppy price action. Okay, moving on to gold. Traditionally moves inverse with the dollar. And there's two reasons that's fueling this rise in gold. First one being recessionary fears. Investors are still rotating into gold as a safe haven asset. There is definitely a stealth rotation, because even though we are in a risk-on environment currently, it does look like investors are preparing for later in the year when economic conditions aren't going to be as optimistic. So for that reason, we are seeing a huge rally here in gold, but also due to the fact that the US dollar is weakening, gold and the dollar move inversely, and we are seeing those two big reasons as to why gold is maintaining such a high level of momentum, flirting with an overbought condition with the 50-period CCI near that 200 area. Price did manage to break above 177, came back to retest it a few days, for a couple of days last week, but still showing some very good bullish price action, set to open a little bit higher this morning. This does look like price could reach 182. Hopefully we see a bit of a pullback. Price is finding support at a 21-day exponential moving average. If we see a bit more of a pullback, I think that's probably a good entry point, for a bullish entry point for gold. Right now, it's a little bit difficult to justify a bullish entry point when, momentum is very close to an overbought condition. That being said, we've said that earlier as well, and it's a difficult entry point when momentum is so high and it is almost consistently overbought. But there are fundamental drivers for this gold rally, which is why we are seeing such a high level of momentum being sustained. Okay, moving on to oil, looking at light crude oil futures. And overall, the price action here is bearish, but very, very choppy, as you can see. We are running into some minor resistance at around between 82 and 83. price has managed to grind up higher to that area, but again, not a lot of bullish momentum. Even if we do see a breakout, I'd be surprised to see price breaking above 92 just yet. I would say my sentiment is still more neutral. Even so, we have resistance here. So short-term sentiment, I should say, would be bearish due to the risk to reward bearish entry point for a move lower to 72. And if we break below 70, 72, that opens the door for 61. I don't expect oil to break below 61. The fundamentals aren't there for oil to move that much lower, because even though we do have recessionary fears, a lot of that has been priced in, and there's a lot of pricing in of a soft landing for a recession. So that is also helping oil move higher, as well as the reopening of the Chinese economy as well from their zero COVID policy. So we do have those fundamental drivers for oil dictating price action. For now, it is quite choppy. I'm more neutral, maybe leaning short-term bearish, just due to the fact that price has rallied to 82, and there's an opportunity for a revisit back to like that 75 area or so. So take a look at some energy companies, and actually we know energy companies are definitely on the back foot due to the fact that oil is pulling back at a time when the overall market or the rest of the market is moving higher. And Bitcoin. So interesting price action here. Last week we spoke about this tremendous rally all the way to 21,000 and how severely overbought price was on the daily time frame. 50-period CCI nearly at 600. I would consider 200 to be overbought. 50-period CCI almost reached at 600 level. And we are seeing it decline, momentum decline, but price is still moving a little bit higher. So definitely a slightly more bullish case for Bitcoin now, especially with the fact that it's broken above that 19K, 18 to 19K area. However, when it comes to the entry point, I would say it's very dangerous to enter a long position here in Bitcoin, considering it's still overbought. 50-period CCI still at around 200. And it's just, there's resistance here. There's resistance at around 24,000. If anything, I'd be waiting for a pullback. Hopefully we get a steep pullback to around back to 19K, retesting that level, because we didn't get a retest there was too much momentum for a retest. So we didn't get a retest on the daily time frame. And hopefully we do get a retest. And from there, look at bullish price action. And that would just give a much better risk to reward bullish move higher. In terms of longer term, where do I see Bitcoin going? I would say price could easily be capped at around the 28,000 area. We might be in a risk on environment right now, but later on in the year, we don't really expect to be in a risk on environment. And for that reason, risk assets won't be performing as well. And that is a 61.8 fib level. So I did cut that out by mistake. I apologize for that. Been cutting out a few, cropping a few pictures, and yeah, not great. But that is a 61.8 fib level at around the 30,000 area, 28 to 30,000, where I do see the best case or the most bullish case here for Bitcoin over the next few months. Right, taking a look at sector rotation, we have 8 sectors in the improving and leading category, and we have 3 sectors in the lagging and weakening. Sorry, that should be 4 sectors. It's 4 and 7. I apologize for that. Because financials did move from the leading category into the weakening category. So financials is experiencing a slight deceleration, but also most of their biggest names have already announced earnings. So, we may see that across the board with other sectors as well, once those sectors get more of their bigger names announcing earnings. Energy, strong rotation out of it. Still, that's due to the oil decline. Utilities, real estate, and communications in the improving category. Utilities could rotate back into the leading category. Municipal bonds are a little bit more attractive now that we know where interest rates are heading. So that is a bull case for utilities. And it's a nice defensive sector as well for later in the year, but looking like it is rotating into the leading category. We have technology showing some signs of life in the last few days, but again, this is a weekly sector rotation, so it's not going to be reflected just yet. But if we do see technology moving towards the leading category, I do expect to see further rotation out of these other sectors in the leading category with industrials, materials, and even staples, because what we normally tend to see is technology lead markets, and due to the fact that it has such a high weighting in the S&P. And when technology does well, you tend to see the rotation out of the other sectors and back into technology. Looking at discretionary, some signs of life, with earnings being a bit of a catalyst so far, but still, in my opinion, it's going to be an underperformer for the few months ahead. I just think that consumer spending is naturally going to decline in a high interest rate environment, and discretionary is very much exposed to that. Okay, moving on to some subsectors of interest. So an idea that I've had for a long time here is KWEB, which is still doing quite well, recently breaking above 32, coming back to retest it slightly. Pity we didn't get a further pullback. That would provide a much better bullish entry point, and moving higher, running into some short-term resistance at 35. But I do think, with technology doing well, with the Chinese economy reopening, there is a potential for a breakout sooner rather than later, above 35, and a continuation higher to our overall price target of 39.50, which is a major resistance level here for KWEB. So look for bullish opportunities, look for those pullbacks to enter those bullish opportunities. But we are definitely seeing, resurgence here in this ETF. Looking at IBB, which was an idea from last week, from 2 weeks ago, actually. So we were initially bearish at 133. After seeing that bearish price action, that became invalidated, but I still maintain a bearish thesis below 138 because that is another resistance level. And from a relative performance point of view, biotechnology has not been doing well against the broader markets. Yes, it might be moving somewhat in tandem with it, but we are seeing, price reject 138 just after last week's webinar. And even though it's coming back to retest it, the relative performance just isn't there compared to the other subsectors and to the overall market. So risk to reward wise, it is a good bearish opportunity if you are looking for bearish opportunities. And, if price breaks above 138, sure, that would indicate a rally back to 143, which is the next key level, major area of support in the past. Could turn resistance. It actually did act as resistance on the daily time frame before. But for now, my thesis remains neutral to some slightly bearish, just due to the fact that it is underperforming the broader market. And if you are bullish on this, I do think there are other better bullish options out there. Right, taking a look at SMH, which is the semiconductor ETF, and we have a pretty significant breakout this week so far with yesterday's bullish price action with technology stocks. The price managed to break above and close above the 230 area, which has been acting as resistance. I mean, even a few days ago, it looked like we saw bearish price action that would have been indicative of a move lower. But we have earnings, and we had some comments from the Fed indicating that, which was good news for technology stocks, that actually saw a breakout above 230. A lot of momentum behind this breakout. So the next key area would be 246. That's a very short area, but overall, you're looking at around this 250 level as another key level to be looking at. Has acted as resistance in the past, as well as support. So that would be the next area here on the daily and the weekly time frame that I'll be looking at. If it breaks above that, you're looking back to those previous all-time highs or near all-time highs at around 280. That'll be the next key level. But for now, I'll be focused more on 250 as the target here for semiconductors. Okay, moving on to some bullish and bearish market observations. This is a bullish idea that I have for you today. That is Oracle. Now, Oracle, nice, stable technology company, which in a rising interest rate environment, sometimes it is nice to see, especially with the rebound that we are seeing in technology. Weekly time frame, 84 is a key level to be looking at. We saw price initially react negatively there, but managing to break above that resistance level, coming back to retest, as you can see on the daily last week, and moving higher with some good, positive, bullish price action finding support not only at 85 or 86, but its 21-day exponential moving average. So this does indicate, continuation higher. And again, the fact that Oracle is nice and stable, it is an attractive, bullish, short-term idea for me from a fundamental perspective as well. Next key area is naturally 92. Now, 92 has acted as resistance on the weekly time frame, so not a lot of room to the upside. But if we see a break above that, you're looking back at price potentially revisiting that 100 level. Okay, a bearish idea that I have for you today is actually GM, General Motors. So General Motors, reason it's bearish is because of its poor relative performance against the broader market. I am long-term bullish on General Motors. I think they have a great EV, EV range of vehicles, and they've gone through a multi-year restructuring process that has actually helped with reducing operational costs, which was their main focus. But now we are seeing a bit of bearish price action, poor relative performance despite that, with price finding support on this trend line, but running into resistance between 37 and 40. So if we do see a revisit back to 37, bearish price action, from there I'll be looking for a bearish entry point back down to potentially the 34 level or this trend line. But for now, until General Motors breaks above 40, I would say I'm neutral to slightly bearish in the short term, but longer term, I do think this is an attractive opportunity, attractive bullish opportunity, I should say, over the next few years. Okay, JP Morgan. So JP Morgan, a name that we have looked at in the past, but I wanted to highlight it again because I think I see another good bullish entry point. So originally we were bullish at around 127, and it did well. It was a trade that did well. I said, you'd want to take profits at around that 138 to 140 level, and price did manage to pull back. So it was a good thing that we took profits around there. But what we saw was a double rejection of 133 on the daily time frame last week, bullish price action today. So nice pullback and bullish, followed by bullish price action, increase in momentum. That provides an excellent risk to reward bullish entry point for a move higher, with 146 or 145, 146 as my upside target here for JP Morgan. So you can see it's a very key area here on the weekly time frame as well. Now, when it comes to JP Morgan, I do like this over other banks. Reason being, well, one, obviously earnings has already passed, so there's less of an uncertainty factor there. But also, JP Morgan's relative performance against the likes of Goldman Sachs, Morgan Stanley, even Wells Fargo, its relative performance has been very, very strong. And those are the names that you want to look at, because even if, just say, things go badly for banks, or there's a broad-based decline in banks, JP Morgan should decline a whole lot less than these other companies. So there's less risk from a relative performance point of view, and there's more reward from a relative performance point of view. That is why JP Morgan is my pick of the major banks. And right now, I am seeing a nice bullish entry point for that move higher. Okay, looking at Visa. Visa, originally a bearish idea that we had a couple of weeks ago, bearish price action at 221. And that, I would say, that somewhat became invalidated. Yes, we didn't see a full-on breakout, and you could argue that this, resistance is actually between 220 and 228. But overall, this was a credit spread idea that just hasn't gone our way. But the fact that it's a credit spread means that you can get out of this trade for fairly limited losses. And I do think now is a good time to get out of this trade. The fact that it just hasn't, the timing element was probably incorrect. Even where price is currently now, I would argue, yep, that does look like a good risk to reward bearish opportunity, but price does seem to be, staying above 220, which, our original thesis is somewhat incorrect, even though I would say the direction is still hasn't been invalidated. I would say this is just an example of slightly incorrect timing. We could have been more patient, waited for a revisit to that 228 or near 228 for that bearish entry point for Visa, in my opinion. Also with momentum, flirting with that overbought condition, So again, risk reward does favor the downside, followed by, an expectation of lower consumer spending. The fundamentals for Visa as well are somewhat limited. All right, taking a look at NVIDIA, and NVIDIA, name that I had a short-term bullish outlook here for last week, but also a longer-term bullish outlook for NVIDIA due to the fact that it produces components for AI chatbots like ChatGPT, which is clearly taking the internet by storm. NVIDIA provides great exposure to that, and especially because they're focused on the more higher end chips and stuff. So for that reason, longer term bullish thesis for NVIDIA remains. I think the fact that it's taking continuous market share from Intel, its fundamentals are very good in the semiconductor space, which is already quite competitive. But the fact that AMD and NVIDIA just stand out and are continuing to gain market share, that does provide a longer term bullish thesis. However, in the shorter term, we saw a break above the 21 and 55-day exponential moving average, saw a bit of a pullback, followed by very bullish price action. Now at minor resistance at around that 190 level. And that's fine. I do think there's most likely going to be a breakout above this and a revisit to 211. So I would hold my bullish thesis for now. However, taking a look at the weekly time frame, we are seeing we're at the precipice of what is going to be a very significant breakout after a strong rally, strong decline, followed by and a range, essentially what has been a range bound market and consolidation between 120 and 190. Very large consolidation range, but still, looking at the chart, it's still consolidation. We are seeing now that breakout here on the weekly time frame for that move higher. So entry point for NVIDIA, especially for a longer term holding, I think it's still very much valid. Right, looking at MSCI, which was a bullish idea that we had last week. And this is a trade that worked out quite well for us. We were bullish after price broke above that 21 and 55-day exponential moving average. And there was a lot of momentum to see price reach our 520 level exactly. And that was our target price. And already we saw a couple of rejections there. So if you did get into this trade, this is where you'd want to take profits and move on to the next one. And finally, we have Dexcom. So Dexcom, another name that we've discussed for a few weeks. So I did have a bullish thesis on Dexcom with price staying hopefully above 110, which actually failed, but there was a gap fill opportunity, followed by initially some bullish price action, which is why I maintained that bullish thesis. However, there just hasn't been enough bullish momentum, even though momentum is improving somewhat on the daily time frame, recovering from an oversold condition. It's still stuck between 104 and 110. So I think that this was a credit spread trade. So if we were to close this trade now, it would be a fairly limited loss. And I do think now is the right time to close this trade. We're just not seeing that momentum that we want to see. But again, limited loss, so not the worst thing in the world. And with that, that is all I have for you today. Thank you so much for joining me today. And I hope you all have a great trading week. I should see you tomorrow for a Firstrade education event for cash secured puts. So I hope you all can join that and have a great trading week, everyone.